Hello and welcome everyone to today's ISTAT Learning Lab, where we're going to hear an introduction to Enhanced Equipment Trust Certificates. They're in short known as EETCs. My name is Peter Negline and I'm based in Singapore with BOC Aviation. I'm also a director of ISTAT, responsible at this stage for ISTAT Online. Fortunately, today I'm joined by another ISTAT director, Sarah Aun, and she is the head of Aircraft Investors Capital Markets at Airbus Americas. We're delighted to have you all joining us today for this Learning Lab, and we're fortunate to have with us two expert presenters. The first I'll introduce is Evan Wallach, who is the President and CEO of the Global Air Finance Services, which is an advisory firm in New York to institutional investors that invest in bonds and securities issued by aircraft and engine leasing companies. Evan advises lessors on the purchase, sale and financing of aircraft and aircraft engines, and he's devoted his entire career to the aviation industry, specifically in positions in aviation bond sales and trading, investment banking, debt capital markets and aviation debt restructuring. Today, Evan is also joined by Philip Baggerly, who is a Managing Director at S&P Global Ratings. Philip is the Sector Lead of US Transportation, Aerospace and Defence, and the Coordinator for the Global Transportation Industry Team. He regularly addresses aviation industry conferences and has testified before aviation subcommittees at the US Senate as well as the US House of Representatives. Philip joined S&P in 1985 as a transportation bond analyst and took over direction of the transportation team in 1990. He's had management responsibility for aerospace and defence ratings from 1993 to 2014 before assuming his current role. Now, at the end of today's presentation, there will be time for Q&A, and Sarah will manage that for us. For those joining us online today, please ask your questions through the Q&A button at the bottom in the middle of your Zoom screen, and we'll ask those questions on a first-come, first-served basis, so please don't be slow at getting your questions in there. The recording of this event and the presentation slides will be made available on the ISTAT website in the next 24 hours or so, and you'll find there a growing library of available material on demand. So we want to encourage you and all your colleagues to access those recordings and to learn from them all. And we want to encourage audience feedback as well. Comments and suggestions would be most welcome, and you can send those to us at istat@istat.org. So with that, let me hand it over to Evan and Philip. The floor is all yours. Thank you.
Okay, thank you, Peter, very much. Just a quick welcome to all the ISTAT members here for the Intro to EETC Learning Lab. I had the pleasure a couple of weeks ago to do one with John Mowry as well on Intro to Air ABS. For this presentation, we're very fortunate to have Phil joining us. Many of you know Phil. He is one of the leading experts on EETCs, having rated most of them, since the first one was done by NWA back in '94. Along with his colleague Betsy Snyder, again, Phil's played a very important role in the evolution of EETCs, which is something that we're going to discuss in detail in this presentation. So let me put on the screen. Okay, here we go. All right, so I'm going to start the discussion. Here's the topics that we're going to be covering today. Just a quick definition of a EETC, what goes into it, what's behind it. We're going to look at what are the benefits to the issuers and the investors for this product. We thought it was important to take a historical look at the historical evolution and the growth of issuance from 1980 to 2019, long period of time, but we're going to cover it pretty quickly. We're going to look at the airline credit analysis, aircraft collateral analysis, and then the legal evaluation. We're going to look at who are the participants, how do they structure the deals, and how is the modeling done. And then Phil's going to take some time to go through exactly how the rating process works. This is really the key to the issuer benefits, so it's going to be important in this section. And then Phil and I are going to cover how have the EETCs performed during the pandemic. This would be an interesting discussion from January 2020 until today. And then we're going to open it up for Q&A once we're finished. So just a quick definition, what is an enhanced equipment trust certificate, EETC? Basically, it's a public or private issuance. It's a rated security, and there's a couple of things. It relies on the credit of a single airline issuer. It's secured by aircraft, engines, or parts. It utilizes a liquidity facility, which typically covers 18 to 24 months of interest payments for the bondholders. It utilizes an over-collateralization structure for the senior tranches, and it relies on the legal remedies from Section 1110 of the U.S. Bankruptcy Code or the Cape Town Convention. Okay. Some of the benefits to the issuers. So, excuse me, the bonds provide a lower financing cost due to the higher ratings that are achieved in the structure. It's a relatively short time frame to issue the bonds. The issuers have access to multiple investor bases, both investment grade and high yield. There's a pre-funding option for the issuer, so that drawdowns can match the delivery schedule for new aircraft. Most of the deals provide enhanced operational flexibility, so few covenants or consents are needed during the time frame that the bonds are outstanding. And typically, the bonds have very long amortization schedules. Okay, benefits to the investors. So the EETCs typically are secured by new or newer aircraft with long useful lives. The over-collateralization provides some security, roughly 50% LTV to the seniors, 70% LTV to the juniors. The junior tranches offer higher yields with, we believe, strong collateral protection and typically shorter maturities. The legal structure has been tested with multiple U.S. issuer bankruptcies over the years. There's now a very deep investor base that provides high liquidity. It's important to know that bonds are traded off the corporate debt desks, not the ABS desk. So it's typically a deeper investor base. Secondary trading is being provided now by multiple desks, which has led to very good price transparency and price efficiency. And there's a very deep research library that the multiple investment banks provide to the investors. So like I said, we're going to take a short trip down memory lane. Phil and I lived through most of this, so we're going to bring some personal context to this, but we thought this was important to go through. This chart shows the issuance of ETCs and EETCs from 87 to 2021. Thank you to our friends at JP Morgan for providing this to us. As we said, the first EETC was done by Northwest in 94. And that was followed by, we'll go through some of this, but you can see it peaked in 2001 with about 10 billion, fell off during post 9/11, which we'll talk about, and then picked up again in the most recent time frame. So it's become a very viable, important product. It's still relatively small part of the aircraft aviation financing products, but I believe, I think we would agree it's a very important part. And as we'll talk about, what was tapped in the 2020 market, about 10 billion, I think highlights how important EETC structures have become to the airlines. So just a quick look at what happened in the decade of the 80s. We had deregulation in '79, and that led to this explosion of airlines during the decade. And the big issue is, how are these airlines going to finance themselves? So initially, it mirrored what was happening in the railroad industry with equipment trust certificates. A single airline issued an ETC for a single aircraft. This developed and grew to PTCs, which was just an extension, single airline issuing financing multiple aircraft. Most of these were fixed rate, long-term private placements or 144A. Initially, it was one tranche, with one low LTV. It later evolved into multiple tranches with various bullets for maturities. However, all the tranches were pari passu to the aircraft. So you could pick and choose what maturity you wanted, but basically your collateral risk was really the same regardless. And that's kind of like it. I think the issue here was how can we expand the investor base? So as we go into the 90s, initially we had a pretty deep recession in the early 90s. Air travel dropped significantly. But I guess then some smart bankers and some smart lawyers got together and they said, how can we expand the investor base? How can we enhance the equipment trust certificate? And they put together a structure and a model, took it to Phil and his colleagues at the rating agencies, and they came up with the EETC product in 1994. So Northwest did the first one. As we saw on the chart, it took off, if you will, with the big, all the other majors issuing EETCs as well. FedEx and Atlas then joined in using cargo aircraft as the collateral. And the bonds were used to both finance debt for the airlines as well as leverage leases that were being done at that time. So we hit about 10 billion in 2001. And then unfortunately we're on, track to keep it growing. 9/11 occurred and both the airline travel and the capital markets completely shut down. So we had an interesting during the 2002 to 2007 timeframe. This was a time when the bonds were being tested, and since they really hadn't been tested previously, I think there was a lot of panic selling that was occurring in 2002, 2003. I happened to be on trading desk at that time, so I saw this personally, where basically investment grade investors were worried that they were going to get back their airplanes, and that's not what they were in it for. So a market developed, where on the buy side, where we were taking out investors who really were panicking at that time. So we saw A tranches trade down into the 70s and Bs into the 50s and Cs into the 30s. And we also saw some of the ETCs trade in the teens. And it was a lot of panic selling. Ironically, the buyers for a lot of this paper were some of the aircraft leasing companies who looked at the structure and looked at the pricing and felt like these were, great opportunities to pick up bonds, at aircraft prices that were extremely low, where the bond prices were low relative to the aircraft values. So during this time, though, there was a lot of, this is the structures were being tested. US Air filed, UAL filed, and so the provision in the code that was being tested was basically 60 days to affirm or return your aircraft or affirm your contracts. And so there was a lot of haggling during this time, a lot of legal battles. Distressed traders were taking advantage of the moment. Rating agencies put the bonds on negative credit watch, but over this period of time, the bonds proved to work, actually to perform very, very well. So depending on the structure, it varied by degree and by certificate, but overall, basically EETCs recovered. And you then had other, Northwest filed, Delta filed, and what happened was the reaction from investors when those with those filings occurred is that very less distressed selling because of what they had seen happen during the previous couple of years. So by 2007, bonds were trading, A's were back to par, and B's were in the 90s, and C's were in the high 80s. So things had recovered quite well. Just want to correct this. I have September 07 for Lehman. It should be September 08. Triggered the global recession, and we all know what happened after that. So if we go to the next slide, we can see that from 2008, it was a here we go again syndrome. Rating agencies downgraded all the EETCs. Shortly thereafter, AMR now filed for bankruptcy, November 2011. But what was interesting is that the A tranches basically they hardly moved. Investors were, I think, extremely comfortable with the performance of the EETCs in bankruptcy. So there wasn't much distressed trading during that time, which is I think a great testament to the structure of the EETCs. So as we fast forward, we had international airlines now issuing bonds, EETCs, backed by the Cape Town Convention. And we even had some smaller international airlines issuing EETCs as well, which we'll talk about later. But one of the key structural enhancements that Phil's going to go over in detail was investors were now getting cross-collateralization and cross-default protection across the entire structure. And this, I think, provided, the additional, took out the ambiguity of airlines potentially cherry picking returns and reaffirming, and really, I think, really helped the structure as well. So the issuance continued. We had about 8 billion in 2013, 7 billion in 2015, a very aggressive, all oversubscribed. And then as the airlines continued to grow and do well, actually they started tapping into other markets, and EETCs became a little bit less attractive. So by 2019, I think it's clear that we had achieved very efficient pricing. There was extensive research coverage being provided by multiple investment banks. Multiple desks were trading the bonds. So everything traded tighter and very efficiently. So end of 2019, the bonds were in a very good place. So I thought that was important just to go over some of that history. This is just a pictorial excuse me, depiction of how bonds reacted during these last global catastrophes. And I mean, the basic picture here is that we had a drastic drop after 9/11. Bonds hadn't been tested, but then as you can see over time, when the legal protections, proved to be sufficient, very few aircraft were returned. Bonds, started to perform, didn't drop as low, and perform and recovered, much faster. So I wanted to just highlight that. This was a study done a couple of years ago, covering the 94 to 14 period. And just to be clear, this is a cumulative recovery rate for all EETCs, not just those in bankruptcy. But as you can see, the performance is quite good. 99.9% for A's, and high 90s for B's and C's. So I think overall, I think we achieved a high level of success with the EETC product. So with that, I'm going to turn it over to Phil, and he's going to go through airline credit, aircraft collateral, and the legal evaluation.
Thank you, Evan. First, I'll just, before we get to my chart here, I'll just add a comment on the historical study that you were talking about. JP Morgan and some others did a study. There was a follow-on later on by Kroll. And I think it's important to emphasize what you said, that this is all EETCs, whether there were bankruptcies involved or not. And it's talking about ultimate recovery. In some cases, there could have been payments after the maturity, which we would consider a default. But overall, certainly the picture is very good. Okay, as to this colorful chart here, this is the methodology that we use at S&P to rate non-financial corporates. So this is not unique to airlines, but the starting point for credit analysis of EETCs is the credit of the airline. Just very briefly, if you look in the upper left-hand corner, the blue boxes, those are some qualitative assessments of aspects of what we call business risk profile. The countries that they're operating in, industry risk, and airlines fall into a relatively high risk category, no surprise, under our methodology. Competitive position, which isn't just market share and things like that, it's also operating efficiency, scale and diversity, and operating profitability. And those come together to score a business risk profile. Then on the bottom, the red area, this is the more perhaps familiar quantitative analysis, calculating credit ratios based on historical and projected performance. And based on that, coming to a financial risk profile. We combine those to what we call an anchor, which is sort of a preliminary analytical outcome. And then that can be affected, nudged up or down by some of these modifiers you see in the tan box here. Various specialized topics. Liquidity obviously has been very important in the recent times. That gets you to a standalone credit profile, which in most cases is the same as the final rating. Sometimes there's a government or some group that has influence on it. And we get to our issuer credit rating. That's the bankruptcy risk of the company. And I'll make a sort of disclaimer for this, and when we talk about how we approach EETCs, the main reason I bring these up is that these are factors I think you should think about. Different credit analysts or rating agencies put them together in different ways. We're not saying ours is the only way to do it, but they are things I think that you should bear in mind if you're starting out looking at EETC and first have to think about the credit of the airline. Next slide, please. Next, I'm just going to mention a number of other factors that are going into looking at a EETC briefly. A little bit later on, I'll talk about how we put them together in our analysis at S&P. But the first point is the one we were just going over, the corporate rating, the risk of bankruptcy of the airline. The EETC ratings, that folds in a number of specialized factors that provide ratings uplift. Part of that assessment is what's the likelihood that the airline will reorganize, because if it doesn't reorganize, affirming does you no good, you're going to get your plane back. And then mentioning also the airline's ability to fund maintenance. This is not like an aircraft ABS deal where there may be a liquidity amount sized for maintenance. This is a corporate obligation. The airline operating the plane is responsible for performing maintenance. And so that's something just to bear in mind. This usually only matters at sort of the extremes, particularly if you're at risk of getting back a lot of older planes with run-out engines and so forth. Next slide, please. Collateral evaluation, very important. And a lot of this will certainly be very familiar to our audience here. Different types of planes, and we'll go into how we think about the relative quality, if you will, of different categories of planes. Engine choices, of course, can affect the liquidity depending on how many of each type are ordered. An assessment of how important we think these aircraft that are collateral for a particular EETC are to the airline's reorganization. Are they the planes that they would most likely want to keep, or candidates for rejection? How broad is the aircraft user base? Liquidity, remarketing time. Obviously, some types of planes, you have a better chance of putting them back to work than others. And technological and obsolescence risk factors into how we would look at quality of an airplane. Next slide, please. Legal considerations. And there's various categories of these, which I'll go into, but I mean, the first thing to know is that these are full recourse obligations to the issuer. It's not just based on the collateral. The airline is responsible for paying all of the debt service. Section 1110, which we've heard several times in the Cape Town Convention protections. Basically, what Section 1110 says is that within 60 days of filing for Chapter 11 reorganization, an airline must agree to affirm, and that's to agree to perform on its aircraft obligations, make good any past due amounts, and perform going forward, or the secured creditors or lessors of those planes can immediately take the plane back. They don't have to wait till the end of the bankruptcy. So it's a quicker and more efficient means of realizing on your collateral, and it places pressure on the airline to make some decisions about what it wants to do. Now, that's not to say that there might not be consensual bargaining back and forth between creditors and the airline that could go past the 60 days, but the creditors would have the right to take the plane back after 60 days. Cape Town Convention is an international treaty. It first began to take effect in the mid-2000s. Quite a few countries have signed on to it. The intention of that is to provide legal protections for aircraft creditors, and actually it applies to other types of equipment too, which are similar to Section 1110 in the US. And the idea was to try to lay a legal basis so that investors would be comfortable buying this type of a security, a EETC, from airlines outside the US. The whole effort was sponsored by various manufacturers, bankers, lawyers, and it's been quite a large and long-running project. Evan mentioned cross-default and cross-collateralization. What this means is that the secured aircraft notes that are against each individual aircraft within a EETC, those notes are cross-collateralized and cross-defaulted. So the airline cannot selectively turn back one plane, and this was a weakness in the structure before 2009, that airlines sometimes did turn back the old run-out planes. And so we think this provides extra protection for the creditors and give credit for that. Foreclosure, repossession, sale rights for each tranche. There it's the creditors, of course, would have to enforce and repossess planes and sell them. And that gets into the control provisions. The majority of the senior class of a EETC is the controlling party and directs what they want to do as far as negotiating with an airline, repossessing and selling collateral. The subordinated tranches do, however, have rights to buy out the senior classes above them. They'd have to buy out the entire amount, but that gives them the right to take control if they're willing to put up the money to do so. Next slide, please.
Okay, I think I'm going to jump back here, Phil. All righty, so let's look at who are some of the participating parties in putting the EETC together. Obviously, it's the airline, which would include the cargo carriers. The investment bankers provide the structuring skills, and then also the selling syndicate is put together. Phil and his colleagues at the rating agencies are absolutely critical to the structure. Legal counsel for all the different parties, different classes. The liquidity facility provider is instrumental. It has to be at a certain credit rating going forward, but critical to the structure. The appraisers are obviously very important in their valuations for LTV. You have various trustees at the different levels. And if the deal is a pre-funding structure, there's going to be an escrow agent, which is going to take possession of the cash and then distribute it as aircraft are being delivered. Looking just quickly at structure and modeling, obviously, the deal works with senior and subordinated tranches. Sometimes two. Sometimes there's three tranches in the deal, but typically it's a senior and a sub. The over collateralization is critical to achieving the ratings. And then there's annual testing, which occurs as well on LTVs. The repayment profile, amortization and maturity is going to be driven a lot by the life of the aircraft. But typically, these are on newer planes, so they're pretty long. Liquidity facility sizing will be determined. The waterfall now is pretty generic, covering sequentially the different payments through the bonds. All the legal considerations, Phil's going to talk more about those later, but we went through how those are providing protections to the investors, and then the buyout rights and collateral substitution and release of aircraft are again very, very important for the issuer to have that kind of flexibility, and then the buyout rights for the subordinated tranches are also very, very important. I'm going to turn this back to Phil, but this is a picture of what the structure looks like.
Yeah, this looks perhaps kind of daunting, but let me take you through it. And I'll point out that this has some, it shows some arrangements which may not be present in all deals. So any particular deal might look somewhat similar, somewhat simpler than this. So if you start at the top, the airline, of course, makes payments. It can either be lease rental payments or mortgage payments on each aircraft. And so there are notes on each aircraft. And actually if there are multiple tranches, there's a senior note and then a junior note and so forth on each airplane. And so those payments, if we continue down, go to the subordination agent, that's a bank, which is simply tasked with parsing out the cash flow per the cash waterfall defined in the documents. If you look over to the left, the other part that could be is if this is a EETC based on leveraged leases, then the payment amounts beyond that for the debt would be going to the owner participant, the equity in the leveraged lease over on the left there. And then over on the far right, we've got our liquidity provider, which is there to provide cash interest payments, generally for up to 18 months in the case of bankruptcy, and covering time to sell the plane and so forth. The payments go down from the subordination agent, and there are trustees for the different classes of debt, and you're getting all the way down to the certificates there. Over on the lower left, you see depositary and escrow agent. If the deal is financing new deliveries, the debt would be issued, the certificates would be issued, the cash is placed in escrow, and it is used to buy the planes as they are delivered, and the airline would provide an equipment note as each plane goes in. And when everything is delivered, it would look like this, and the depositary would no longer be part of it. Next slide, please. Okay, the EETC rating process, and Evan calls it the key to issuer benefits. And I think the reason why we would say this is that this product was structured to try to achieve high ratings from rating agencies. The way it's put together and so forth is to do that relative to other types of debt. Importantly, the certificates themselves are rated on, and the terms of it are timely payment of cash interest and ultimate repayment of principal. Now, I will say different rating agencies have different approaches as to what's acceptable in terms of the interest coverage. I'm describing what is typical for almost all, certainly public EETCs in terms of the structure. Next slide, please. This is sort of a conceptual basis for how you can get to high ratings or how you get to good credit protection. Because the EETC has to blow through a series of layers of protection before it actually defaults. The first one on the left, obviously, is the airline bankrupt or not? And if it's not, you green light, you're paid off. Then the question is, all right, if it's bankrupt, does it affirm the obligations or not? If it does, and it reorganizes, then you are covered. If it turns the planes back, is the collateral going to cover the principal and any liquidity draws and other expenses? Finally, I have something about deficiency claims. That's not something that we actually try to model in our ratings, but it is something which creditors have gotten the benefit of in some bankruptcies. Like other forms of secured debt, if there's a shortfall, collateral cannot fully cover the debt, then the shortfall is an unsecured claim in the bankruptcy. And this would be true for each level of debt. So let's say that the senior class is mostly but not entirely covered. That would be a shortfall, unsecured claim. The junior class would not be covered at all if the senior class is not getting fully repaid. So that's another unsecured claim. And importantly, these unsecured claims, any payments that arise from them, those would flow through the cash waterfall, and the A class gets first crack at all of them. So the A class is getting the benefit not only of its unsecured claim for its own shortfall, but also for the shortfalls of classes under it. And sometimes senior classes have gotten fully repaid by using those deficiency claims. And if all of that fails, then yes, at the end, you do have a default. Next slide, please. Okay, now this schematic might look a little bit familiar in general form and colors and so forth. And that's because I adapted our corporate methodology as a way of showing how we put together the various pieces to get to a EETC rating. On the left-hand side, you're starting with the airline rating. Then there's credit for the likelihood that the airline would successfully reorganize and choose to keep paying on these obligations to keep the planes. That's affirmation credit. Legal assessment goes into this. It actually goes in a number of places, but one of them that we look at is legal jurisdictions around the world. Those come together to make a EETC profile before collateral credit. On the bottom, you've got the numbers part again. Collateral assessment, that's basically our approach to judging what's the quality of the collateral as protection for the creditors. And then the loan to value, how much is it covered? Now, we've been using that term, and you might wonder, well, where do the appraisals come in? When we're rating a new deal, we would see appraisals from several appraisers, generally on both a base value and a current market value basis. In some cases with maintenance adjustments, we would compare that with some of our own internal appraisal sources and have a starting value for the aircraft collateral and then model how does that cover the EETCs throughout the life of the deal. So there's notional forecast loan to value throughout the life of the deal. We have depreciation assumptions, just as appraisers do. And I'll point out that we continue to surveil the deals and follow the loan to values. In a typical EETC, there's not actually an annual appraisal that goes to the bondholders. The ongoing surveillance would really be from the parties that hold them. However, if there's a bankruptcy, then there are provisions in the documents that would call for some appraisals. The EETC profile before collateral credit and the collateral credit come together to a preliminary EETC profile, and that can be affected by some other specialized topics. I won't go through these. I'll just mention one of them. Down at the bottom there, it says counterparty limitations. That's talking about things like the rating of the liquidity provider and of the depositary bank. Each rating agency has guidelines for what sort of a rating for liquidity banks would be acceptable to support a particular rating for EETCs. And the general practice on these is that the liquidity provider agrees to replace itself with a suitably rated substitute if it falls below a certain rating which is defined in the documents. So there's a replacement mechanism, and that enables liquidity banks to support classes of certificates that are rated higher than the bank's own rating. We put all those things together and get to the EETC rating. Next slide. Going a little bit into what we look at for these various factors. The affirmation credit is based on, as I mentioned, first of all, obviously the airline has to reorganize for it to matter. The likelihood of affirming the aircraft notes or leases. And this gets into making judgments about the airline's future fleet plans. So obviously in the recent period, a number of airlines have announced that they're taking early retirement for some of the planes, some older wide bodies and so forth. So clearly decisions like that, or our expectation that decisions like that might happen in a bankruptcy, are factors into judging the likelihood that they would affirm those. Then there's the cross-collateralization and cross-default that I mentioned. The seniority of a class within the overall EETC structure. Now, the reason why this matters for affirmation, as well as obviously for collateral coverage, is that in a legal sense, an airline either affirms or rejects, so it's binary. However, in the real world, what you can sometimes have is that there's a rejection, but then the certificate holders and the airline enter into a new agreement, which perhaps changes the amortization profile, perhaps it haircuts the debt somewhat, and the senior classes are in better shape to still come out whole in some of these renegotiations. And so that's why the affirmation credit has a factor within it for the various classes of debt. And then finally, the loan to value, it's not just a matter of collateral credit, but if there's a very high loan to value, that could tempt the airline to either reject the plane, there's just too much debt against it, or else encourage it to seek a renegotiation of the sort that I just mentioned. Next slide, please. This goes into further detail of what we look at for this, and I'm not going to read all of these, but you can see that there are a lot of considerations for each of these factors for the likelihood of reorganization. It's not just a matter of how big and important is the airline, it's also a matter of, does the legal framework for insolvency proceedings in that country, does it tend to support reorganization, or do companies simply shut down when they go into bankruptcy? And the situation in the United States, not uniquely the United States, but in particular, is sort of a best of both worlds for aircraft creditors. You've got a general bankruptcy framework which intends to try to reorganize companies if it's possible in bankruptcy. So it's debtor friendly in that sense. However, Section 1110 is very much an exception. It's very pro-creditor. So that's kind of the best of both worlds, that it's more likely the airline will reorganize, but you have strong creditor protection rights nonetheless. Next slide, please. Getting into some of the legal aspects, first, there are various legal opinions which are available in all of these deals. I just mentioned a few of them, more from what this means about securing protection or providing evidence that you're going to have creditor protection. So first, the applicability of Section 1110 or the Cape Town Convention, or certain laws in other countries that are relevant. So you want to make sure that you do have that legal protection that you think you do. Perfection of security interest in the plane, obviously. There are various special purpose entities, just legal shells through which payments flow in these deals. And we would look for opinions that these will be bankruptcy remote. Now, bankruptcy remote doesn't mean remote from the bankruptcy of the airline. Clearly, if the airline goes bankrupt, there's no cash coming in, at least from that source. But the idea is you don't want the SPE to somehow go bankrupt when it's not caused by the airlines, or for the airline to somehow be able to make that go bankrupt. In a sense, you want to make sure that the pipelines that are carrying the cash flow, none of them spring a leak. And then there are various other possible opinions depending on the structure. Next slide, please. The other aspect of legal, which we go into in some depth when EETC is issued for the first time in a country where there hadn't been before, are some of the factors we have here. We're looking at the general legal provisions of insolvency. How well do they treat lessors or creditors? For example, under Section 1110, Secured debt and leases are treated the same in bankruptcy for aircraft and also for rail equipment. But that may be different in other countries, that often leases are treated more favorably than secured debt. What about the ability of creditors to repossess the collateral if they're not getting paid? Do we think the courts are likely to apply this? For us to be rating a EETC, we have to have a certain level of pretty high confidence that it's going to work as intended. But there are different levels of from confident to very confident and so forth. Next slide, please. And then we get to the collateral assessment. And this will be familiar to many in the audience. So we're looking at resale liquidity of the planes, and that's the most important single factor. How large is the fleet? How many orders are there? The number of airlines that operate it, engines and other specifications. So we're looking at a lot of the same things I think that appraisers would look at, and also fixed income analysts at the banks or investors. Technological risk, obviously the fuel efficiency, the technology embedded in these, and that may become increasingly important to the extent that environmental regulations get more stringent. We have a factor for the age of the aircraft. This kicks in when you have planes that are more than 15 years old or more than 20 years old. And then we have depreciation assumptions. And this is depreciation assumptions on what you might call sort of a base value approach. We're not trying to time the cycle as far as this. We're saying that this is the trend rate of depreciation of the aircraft. And I mentioned a base value basis. One thing which is important and relevant to appraisals, how we use them. Generally, we would focus on a current market value the closer you are to a situation where the creditors might get the planes back. So that could be either because you have a weak credit, or it could be because you have a stronger credit, but planes that you think would be turned back in bankruptcy. To the extent that we have a relatively stronger credit and planes that we think it would want to keep, we're willing to start out with base value and look at it on more of a trend basis. But this switches. I mean, as airlines are downgraded, we may go to a current market value basis, or if there is a change in what we believe is the likelihood that the airline would keep the plane, that could be another factor. Next slide, please.
Okay. Okay, Phil, I'm going to take it over. Thank you very much. I mean, as you can see, a tremendous amount of analysis and processing goes into, you know, the EETC rating analysis. And, you know, we now have, you know, 25 years of issuance and experience going through this, but and it's become pretty efficient. But you can see how much thought has gone into it over the years. So. Just to go through what's the pricing process now once the rating analysis has been done. Phil comes back to the bankers with the preliminary ratings based on their modeling and their structuring, and the loan to value. They determine, you know, what the average life and duration, final maturity will be. We look at where the underlying treasuries are as well. But what we have. Fortunately, there's been so much issuance that the bonds are trading that are out there in the secondary market do tend to trade very efficiently, very tight spreads. And so in normal markets, you know, the pricing is pretty much determined by where bonds have been trading for that issuer with similar collateral, similar profile. But we will get into looking at the issues that we saw in 2020. Where a lot more analysis had to go into what the pricing should be. Okay, gonna turn it back to Phil.
Okay, as I mentioned, we maintain ongoing surveillance on the ratings of the EETCs. we would change those either because the airline's rating has changed or because we think the collateral coverage has perhaps deteriorated, or there have been decisions by the airline that we think make it more likely that they would turn back the planes in that collateral. On secondary trading levels, I think I'll defer to Evan on that.
Yeah, again, as I mentioned previously, you know, over 100 billion or so has been issued over the time frame. So I think that most bankers, investors would feel that in normal markets, the risk return profile for secondary trading is pretty much determined by the investor base, and it's pretty efficient right now. Okay, going to go to conclude with a discussion about how well EETCs have held up during the COVID pandemic. So just to get started with this discussion, you know, let's look at what was issued in 2020. And so obviously we had the global shutdown in March, April, unprecedented to have an entire global fleet shut down and grounded. It almost could be said it could be a little worse than it was at 9/11 because the global the global shutdown has continued, you know, quite a bit longer than it did after 9/11 as well. But after the airlines had to determine if, you know, whether they were going to survive or not, and they were able to raise a tremendous amount of capital. Initially, it was coming from government support and their own liquidity sources. But if you look at the EETC market, I think it was, you know, extremely important to the airlines. Yeah, Alaska even came in, you know, with $1 billion issue in June. So you can see most of the new issue was done June, July, August of last year. Coupons were very high relative to where they were pre-COVID. And so that's where the pricing trade-off was heavy negotiations between investors and issuers during this time to determine what is the right price level, you know, for the risk in June of 2020 and July of 2020. And as you can see, the coupons were pretty significantly higher than where they were pre-COVID. United came in with its $3 billion issue in November. And this really, I guess you could say, was the culmination of, you know, all the EETC technology that had been developed, because it was engines, it was aircraft, it was parts. You know, so rating agencies had to really look at the collateral protection and value to determine what the right rating should be, given, you know, everything they were throwing in. So we had about 8 billion of A's, and then about 1 billion of B's were issued as well. And as you can see, the B's, you know, had to, you know, again, had to pay significant premiums over pre-COVID levels. But the key was, you know, it was available. These deals were all oversubscribed, and the market really, the investors really liked, you know, they liked the EETC, the structure, the collateral. So it was just a question of price, and this is where the bonds ultimately got issued. But I think, again, even though there had been a fall off in issuance of EETCs in 17, 18, 19, when the airlines really needed to raise capital and raise it quickly, they came back to the EETC market. So again, I think it was really a testament to the structure and to the importance. I'll just go through, you know, some of these comments, you know, that we observed for this time frame. So again, we saw, again, a little bit of a here we go again syndrome that we saw after 9/11 and after the Lehman bankruptcy. The pandemic hit. IATA's forecast since changed, but it was basically saying we're not going to see a recovery until 2024 at this point. This was, you know, early days in the pandemic. Rating agencies acted very quickly to take action on putting credits on watch negative, and then ultimately, you know, took action to downgrade. And Phil's going to go through some of that next slide. Secondary trading prices, they were distressed, but for a very short period of time. And by July, basically the A's were, you know, in the 90s, you know, B's were in the 70s, C's were in the 50, but there wasn't the panic selling that we had seen in previous downturns. And I think that was really an important point. The big airlines did get massive government assistance, raised billions in the capital markets. We did about 9 billion total EETCs. And by March, April of this year, yeah, I think you could say secondary pricing was back to pre-COVID levels. Again, a testament to the strength of the bonds and the structure. July, August, things had stabilized. Ratings had bottomed out. You know, I think Phil would say outlook stable, but there's certainly a long way to go before we get back to where we were pre-COVID. So I'm going to turn it back over to Phil to go over the ratings changes.
Yeah, this chart here gives some information as to what went into the rating changes that occurred from January of 2020 through May of 2021. And the reason why we cut it off at May is that actually we introduced new EETC criteria in May 26th, and there were some changes that were related to that, but that wasn't surveillance type changes. So you can see that the largest part of the cause of the downgrade in terms of numbers of notches was just the airline ratings going down, on average 2.5 notches worth. Now, I do have to provide an asterisk on that, if you will. American Airlines is the largest issuer of EETCs that we have rated, sort of the outstanding EETCs, about 1/3 of the total. And we lowered American's issuer credit rating, its corporate rating, by 3 notches. So that significantly influences the total here. Aside from the airline downgrades, you've got some of these categories of credit I was talking about: affirmation credit changes, a little more than 1/2 notch, and then collateral credit changes. But it's interesting that the structure part of the EETC, sort of the amount of ratings uplift, that changed, but it didn't change as much as you might think, considering the severity of the downturn. Next slide. So what do we conclude on what's happened recently? Certainly, if you look by the numbers, very few EETCs have defaulted, but that's mainly because there was massive government aid and very generous capital markets to the US airlines, by far the largest pool of issuers, that averted bankruptcies. And then you had the situation of LATAM, which is a deal we did rate, and Norwegian we did not rate, where those outcomes were influenced by the manner in which the collateral was disposed and the controlling parties were changed. And there's still, I believe, some legal battle going on about that. So what would have happened to EETCs if there had been more airline bankruptcies? Well, one thing we think would have helped is the cross-collateralization and cross-default. It would have prevented selective rejections that you had in some of the earlier bankruptcies. But the loan to values, particularly on some of the junior tranches, were pretty high. And so even though you had good collateral in most of the EETCs, you could have had situations where there was a renegotiation that compromised some junior classes. And then some of the fleet simplification that we've seen various airlines go through. Out of bankruptcy, it's just that they're sitting the planes down, they pay off the debt on them, and they go to the desert. If this had been with bankruptcies, obviously those would have been rejections, although there are deals where some planes the airline would want to keep, some not, so that would have been kind of a decision point as to how that played out. And certainly to the extent that you had more rejections and planes on the market, that would have further pressured current market values. So we can't take the exact pattern of events as being the way this would happen in a slightly different situation. But I will say, when you consider just how severe this downturn has been, it's been, multiple sigma off the charts. Actually, the experience of the airlines and certainly of the EETCs has been quite good. some thoughts for the future. One thing which actually helped with US EETCs and earlier bankruptcies was that the airlines had newer planes, many of which were in the EETCs. They also had some old planes that they were probably going to get rid of at one point or another, and they could reduce their debt load by getting rid of those old planes. To the extent that a lot of airlines have kind of cleaned up their fleets and already retired some, it's an interesting question as to how this could affect future bankruptcies, where perhaps not all, but a great majority of the planes are ones that they would generally want to keep. Is that going to create more pressure to perhaps try to bargain rates down, even on good collateral? And then the operating lessors, of course, have they own a larger and larger proportion of the global fleet. They've been major players in the airlines' efforts to restructure themselves. And from a EETC perspective, that has pros and cons. On the downside, there are cases, in the case of LATAM, the airline negotiated with their operating lessors and appeared, and this is, you know, if you will, an opinion looking from the outside, it appeared that they concluded that it was easier and simpler and quicker, certainly, to just negotiate deals with operating lessors than to bargain with the certificate holders, capital market investors who had the EETCs. And so therefore, somewhat surprisingly, and we were surprised, as were many other observers, I think, that they turned back some very good collateral in those in the EETC. On the positive side, certainly lessors are set up to take back planes, redeploy them, and so it leads to a more orderly market, and I think that kind of helped support values relative to what it might have been otherwise if there were more planes that were simply repossessed and sold. Okay, Evan.
Great, thank you. Okay, thank you, Phil. And I think that wraps up our discussion. You know, we tried to cover a lot of material in 60 minutes. Obviously, you know, this is volumes of discussion, but again, we hope this was educational, and I guess we'll turn it back to Peter and Sarah to answer some questions.
Thank you very much to both of you for this very thorough presentation, very informative and quite comprehensive, actually. I do see that we have a lot of questions that have trickled through. Just want to remind everyone that if you do have a question, please do not hesitate to put it in the little Q&A box here. You know, this is intended to be for your education, and our panelists are here to answer all your questions. I'm just gonna, you know, start with a couple of questions for you guys. You mentioned the LATAM and Norwegian outcomes not being alarming, so to speak, or not very assuring. Can you elaborate a little bit more on that? How were those outcomes unexpected compared to what we've seen in previous bankruptcies?
Phil, you want to take it first? I've got my opinion, but you can take yours.
Okay, well, I'll start. The issue is that the bondholders appeared to get less value for the collateral than one would have expected, comparing with appraised values or other things, and that was influenced by the fact that you had the same party or different parts of related parties who were both the buyers of the collateral and the controlling party, and therefore could determine how it was sold, so that it wasn't an arm's length transaction, really. And so that was the basis for the concern. Evan?
Yeah. I would just say that from the historical context, you know, it was the first time that a carrier rejected the whole fleet of it, you know, of collateral. And again, you know, that if you look at LATAM, you know, well-run airline, great management, they now have, they've leased back those same aircraft. So clearly the aircraft were critical to the airline's reorganization, development, and growth. It was a question of value. I think that what we saw was, we saw a trade-off basically saying, you know, we can lease these planes back in cheaper than if we continue to pay off the debt. And so, you know, if we don't believe there's any more equity value in the aircraft, we'd rather reject them and then lease them back in. So the analysis of how important the aircraft were to the fleet I don't think that was wrong. I think that was correct. But you know, as we see in all these downturns, that's when you really get to test the structures, and you get to see, you know, unprecedented things happen, you know, where the markets are different. So I think that was, you know, and then the legal outcome, I think, again, created an exposure which hadn't been anticipated. So that's yet to be determined as to how that's going to play out. But you know, that's how it, you know, yeah.
And just to follow on to that, do you think that there needs to be some changes to the structure at the inception to maybe avoid being in that situation?
Again, I mean, I'll take a first crack. Look, I'm sure the lawyers are looking at it and they're figuring out how to fill that hole, make sure that it doesn't occur again. The issue, though, going to be is that you can't go back to all the deals that have been issued. And so you may start to see a little bit of a discrepancy in pricing between the new issues that have that provision and the majority of the bonds that are issued that don't have it, in terms of risk, in terms of pricing for that risk that's not covered.
Okay. Maybe in the interest of you know, highlighting our ESG content, particularly on WTCs, we had seen recently that BA had a WTC that was that has a sustainability element to it. What was particular about that product, and how is it different than what we've seen before? And is this a product that we will be seeing more of in the future of WTCs?
Phil, you want to take that?
Well, with the provision is that British Airways has to meet certain predefined targets of its overall fleet performance, greenhouse gas emissions, at a particular testing point in the future. And if they do not, the pricing, the coupon on the bonds bumps up a little bit. From a credit perspective, when we rated that as a matter of credit risk, it didn't really change the basic picture. When we were modeling the potential draws of liquidity facilities in future loan to values, we would have to allow for the possibility that it might be a little bit higher if BA doesn't meet it. Separate from that, one could come to your own judgments about this as a value depending on what the investor's priorities are in investing. But I do think you're likely to see more of those.
Yeah. I would just add that, you know, ESG is now, you know, a topic that's in every boardroom, every investor discussion. And I think that I think BA did a good job putting it into their WTC structure, but I think that it's really just going to be a generic component of all aircraft financings going forward. And it's really being driven by the investors. They want to see that provision in bonds that they're going to buy. So it's a combination of broadening the investor base to bring in ESG investors, but it's also a way to protect the current investor base, or protect issuers from losing some of the current investors by not having those kinds of provisions in there. So it's just an interesting twist to see how it gets played out across the financing structure for aircraft.
Right. One of the questions was that, historically WTC has been primarily a US product. We've seen a couple of non-US WTCs. What do you think it will take for us to have more non-US issuances?
Well, we have a number of deals by Air Canada and by British Airways, so they've been using it pretty actively for a while now. Beyond that, it is sparser. Basically, from the airline's point of view, this is one other potential choice, and it depends on the pricing, it depends on the depth of the market that they're going to be approaching. Operating lessors and banks pre-crisis were offering very attractive terms, and particularly if it's a first-time EETC in a country which has not had the EETCs in the legal jurisdiction looked at and so forth, it is a longer process to get to the point of issuing EETCs, certainly longer than banks or leasing. So there is a trade-off. The bankers would be more familiar with that than I, but
right.
I would agree with that.
Could also be some of the disclosure requirements that some airlines could be reluctant to give. Let's maybe shift gear a little bit. There's a lot of questions on Cape Town. Without getting into too much detail and technicality here, but some members of the audience wanted to better understand how Cape Town serves as an enhancement and the mechanism for an eventual repossession. How is that facilitated in a country that is a signatory to the Cape Town Convention?
Yeah, well, the Cape Town Convention sets up a framework. Certain parts of it are standard, other parts of it are choices that the country would make. And the idea is to set up a mechanism which is ultimately very similar to what we have in the US, with a short time period, very clear repossession rights. And so I guess the two fine points, if you will, are one, the choices that the country makes, the declarations about certain parts, and some of them are stronger than others. In other words, the protection in some countries that have signed the treaty is stronger than others. The other part of it is that typically a country would have to pass implementing legislation to make sure that Cape Town is recognized as being the ultimate basis for determining how those creditors are treated in bankruptcy.
Okay. There's a lot more questions, but we're running out of time. This is obviously a very interesting topic, and to the extent that members of our audience want to offer some very good classes, that free to check that out on the ISTAT website. I'd like to thank our panelists. I don't know, Peter, if you have anything to add before we conclude this session.
No, nothing at all, other than to extend, as you say, thanks for both Evan and Phil for their time today. It's been great.
Thank you. It's been a pleasure.
And thank you everyone who has joined. I hope you found this useful.